Jeff, what is your response? How do we view that Federal Reserve meeting after seeing this data this morning?
Well, the data changes, and so does the view on what happened on Wednesday. You know, the big reaction here is that almost entirely across the board, this is a disappointingly weak number. So I'm very sympathetic to what Dana was saying earlier. The problem is that markets react to data relative to expectations, and so this is disappointing, particularly in the lack of a hurricane impact. You know, there's your 20,000 additional right there. And the issue now going forward is what's priced into the bond market is 50 basis points of a cut in September. So it's this issue of reflexivity now that we're going to get into, and it sets up the Jackson Hole speech really importantly to try to calibrate what is the Fed going to do relative to bond market expectations. You had Dudley on earlier this week talking about how the Fed incorporates that, and if it's priced in at 50, does that mean that the Fed has to go 50? And so the pushback on that is going to be really important around Jackson Hole. But this is now starting to change. And Jonathan, you highlighted what I think is the most interesting market price reaction, which isn't in the bond market, it's in the stock market. And it's that Russell 2000 leading the way downward. So this absolutely, and you pointed out, that had been the rotational trade. If it's maintenance cuts and the Fed can just ease us into a soft landing, then the denominator is what's driving the movement into Russell 2000. But you see the movement today. Absolutely. This is about a growth scare. And now it's about worries that the numerator, earnings and growth and cash flows, are falling. And so you're fleeing the rotation trade into small caps. I think it's a really important observation of market reaction. We can debate whether this is overreaction or not, but the reaction is clearly to almost entirely across the board a disappointing report this morning.
So let's debate this, Jeff, because the Jeff I know would have faded this move in markets, would have been where Mike is, that this is an overreaction, especially the short end of the curve. Is that where you are now?
You know, when the data changes, you change. You know, what do you do? So, you know, I think we've had a little bit of a string here of disappointment on the data, and that's pushing more, you know, Mohammed, on your point about the lags of monetary policy. So it's hard to, you know, stand too far firmly against that. My points in the past, I think, are still valid, that you've had, you know, financial conditions, which we haven't heard as much about from policymakers in this cycle. Financial conditions have been much easier, and that has been supportive. But those financial conditions, as we're seeing today, can change, and they can tighten very quickly, and they can unwind. And so I think that the reaction here, you know, is probably the right reaction. All right, maybe it's a bit of an overreaction, but you're going to push on changing the trajectory from maintenance cuts to calibration cuts, that policy needs to move a bit faster.
So is calibration cut a 50% cut come September? What probability would you put to a 50 basis points cut in September?
You know, I think there's what the market wants them to do, and it's what they will do. I think they want to push back against 50 basis points. I think that's why Jackson Hole becomes important, to kind of get that message out, that the Fed doesn't want to overreact. So I'd put a little bit less probability on 50 basis points than what we're getting in the market today. So I guess that says short term, a little bit of an overreaction. But I think the market wants to push for the 50.